What is up, YouTube? I'm Adam Odell, Chief Investment Strategist of moneyandmarkets.com and founder and co-editor of Green Zone Fortunes. I'm joined by my research analyst, Matt Clark, and we are here for yet another episode of Ask Adam Anything. So, got a brief preview. I believe we have another options-related question this week. It's kind of piggyback what we talked about last week about options. So, Matt, I will let you take it away.
Thank you, and I appreciate that. And again, thanks for doing this. We do this each and every week, and we always encourage people to email questions that you have or comment down below on our YouTube channel of any questions you have. If you want to send some in, feedback@moneyandmarkets.com is the email address. If we do send a question or a video of you asking a question and we use it, we're going to send you some Money and Market swag. So, be a little enticement, if you will. This question does exactly piggyback on the last few discussions we've had involving options, which is one of those rare things. People, don't get into options because they feel like it's over their head. They don't really understand it. It's a lot of lingo, but in all honesty, it's actually not difficult to do, especially when you have someone like Adam, who's been doing it for years, who can kind of walk you through the process. And today's question actually comes from YouTube. Randy asked, please discuss why call leaps on Tesla are going down even when the underlying stock is going up. Now, I want to do this in a couple parts here, Adam. First off, I want you to explain what call leaps are, and then we'll dive into how the correlation between those leaps and Tesla. But first off, what is a call leap?
Sure. So first of all, you gave a great preface to that. A lot of folks stay away from options because they think it's too complicated. Now, I'm actually going to explain some of the more complicated aspects of options pricing, because that's exactly what this question gets at. So this is kind of like a graduate level, so to speak, explanation of how options work. But let me assure you, I've worked with hundreds, actually thousands of brand new novice options traders who have never traded options before. I've been doing this for over 10 years now, and we've helped a lot of people trade options in a very simple, safe, and secure way. Basically, when you're trading options the way I trade them, you're going to buy an option contract at one price, and you're going to try to sell it at a higher price down the road. And that's as simple as that. So everything that I'm going to give you in just a few minutes, as far as the inside and outs of the option pricing, is nothing you need to absolutely understand to trade options with any one of my programs. Home Run Profits is my options trading program that I've been running for 10 years. I give you the exact instructions on how to make the trades, what to buy, when to buy, what price to pay. All we're doing is buying a contract at this price and trying to sell it at this price. So I cannot make it any more simple than that. But we will kind of go into some of the nitty gritty today because we had a great question about that. What are call leaps? First of all, what are calls? You have to break it down even more simply. So a call option is basically a bullish bet on a stock. Okay, so it gives you, if you buy a call option, it gives you the right to purchase shares of a stock at a specified price at a specified point in time, but that's not necessarily the definition you need to know. The definition you need to know of a call option, if you're just trading them, is that you buy a call option if you're bullish on a stock or ETF, and conversely, you buy a put option if you are bearish on a stock or ETF. So obviously, when I'm saying bullish or bearish, I'm talking about a directional move. The person that asked this question must be bullish on Tesla's stock because he's asking about call options on Tesla. So that tells me that he believes the price of Tesla shares are going to go higher, and that's why he purchased a call option. And now he's wondering why the price of that call option is actually going down rather than going up when Tesla shares are going higher. The second part of that is leaps, okay? So leaps are a specific subset of options contracts, and really all they are longer term options, okay? So anything that expires 1 year from now or later is considered a leap. It actually stands for long-term equity anticipation securities, but all you really need to know is they're longer term options. So you can buy an option today that expires on Friday, a weekly option that it doesn't last more than a week. You can buy an option that expires 1 or 2 or 5 months down the road, and you can actually buy an option that expires 1 or 2 years down the road, and those would be called the leaps. So that's what a call option is, a bullish bet on a stock, and a leap is just a longer term expiration contract.
So now to dive a little deeper here, what Randy's asking is the price of Tesla stock is actually moving higher. However, in theory, in a call option on Tesla, in theory, should correlate with that stock movement. So if the price goes up on the underlying stock, the call option price should also go up. But however, with a leap, with the particular leaps that Randy's talking about, that option price is not going up. It's actually going inverse. It's going down when the underlying price is going up. Why would that be? And is that always something does that happen often?
Yeah, so let me explain what might be happening here. So first of all, the premise of the question is that if shares of Tesla go up, I have a call option, the value of those call options should go up as well. And if nothing changes other than the price of the stock, that's more or less true. But there are two factors we need to talk about. One is when you buy an option, you basically are buying some time. Okay, so you have the asset of time on your side because you have a certain amount of time for that move to take place. But every single day when you buy a call option, every single day that you hold it, a little bit of the value of that call option will erode. Okay, it's called theta decay or time decay. So basically, right now I'm looking at a screen of options contracts. I'm looking at Tesla, and I'm looking at the farthest dated options. So basically the ones that expire on June 16th of 2023. These options have 645 days left before they expire. So these are a very long-term option. They are indeed a leap. So for these contracts, if you buy the 800 strike call option on Tesla that doesn't expire until June of 2023, every single day that you hold that call option, it's going to lose $16 worth of value. Okay. So every single day, $16 is going to come out of the value of that option. Now that amount will change as it gets closer to expiration, like in 2023, that $16 of daily decay will actually increase. It'll be more than that. But that's one reason people like to buy leaps, is that when you buy something that's really far out, meaning it doesn't expire for 2 more years, the amount of time decay that you have to suffer is rather small. $16 is not a lot of money relative to the cost of this option. I should preface this by saying that this call option, if you wanted to buy on Tesla, will cost you over $18,000. Okay, so it's $18,000 to purchase the call option today. And then every single day, you're going to lose $16 or more just because of the passage of time. So this is one kind of like a headwind that option buyers have to overcome when they buy an option, because every single day they lose a little bit of value based on time decay. So that could be one reason why this gentleman is asking why his call options are going down when the price of Tesla is going up. He may be having some time decay that's eroding the value of his option. But again, for a leap, the amount of time decay is not that large. So I suspect that's not what's going on with this gentleman's position. The second thing we need to talk about is volatility. When you buy an option contract, just like when you buy a stock, you can either buy it at a very cheap valuation or you can buy it at a very expensive valuation. And I've actually talked about this before. I mean, over the past 18 to 24 months, a lot of new retail novice options traders have entered the market, and they've bought a ton of call options, basically on Tesla and a lot of the meme stocks, a lot of the hot stocks right now. And they make the assumption that if you buy a call option and the stock goes up, then that call option is going to go up as well. But a lot of them are overpaying for the options. Basically, baked into the price of an option is an assumption of what the volatility of that stock will be moving forward. Okay, that's called implied volatility. Implied volatility is based on how much real traders, real purchasers of those contracts are willing to pay for the option. The more they're willing to pay, the more the implied volatility is. And that means that I'm willing to pay more for an option because I expect the stock to be extra volatile. You can compare that value, the implied volatility, to the stock's historical value, how much volatility is actually experienced in the past. Okay, so let me give you a concrete example. For Tesla right now, the historical volatility is 36%, meaning in a 1-year time frame, we can expect shares of Tesla stock to be volatile to the 36% level on an annualized basis. Okay. Right now, if you were to buy the leaps that I was just talking about, the 800 strike leaps that expire in 2023, you would have to pay the equivalent of a 52% volatility. Okay, so historically, Tesla has been this volatile, 36%, but you're having to pay as if it was this volatile, 52%. So you're basically overpaying by 40% for this option, what you should be paying, just specific to the volatility component. So what happens is if you pay this higher level of volatility, but then once you buy your call option contract, other traders that go in to buy the contracts after you start thinking, you know what, it's probably not going to be that volatile. I don't want to pay this much for the option. That implied volatility will start to come down, 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 and down. And as the implied volatility of the option that you bought comes down, the value of your call options that you bought are going to go down as well. So this is probably more likely what's happening with this gentleman. He might have overpaid for volatility. Maybe he bought these call options when the implied volatility was 60 or 70 or 80 or 90. Sometimes they can get really expensive. And then if the market, if their expectation of volatility crushes back down and goes much, much lower, then the value of that option that you bought can go down pretty quickly, even if shares of Tesla are going higher. So I realize that's a mouthful. It's quite an explanation. But the take-home message, if you get nothing else from this, is that you need to look at the implied volatility when you buy an option. If the option contract costs $200 or $400, you need to figure out whether that's cheap or expensive. Because if you buy an option that's too expensive, the likelihood that you will earn a profit on that, even if the shares of the stock go higher, you have that headwind against you. So again, just a kind of a plug for my service, Home Run Profits. I take care of all this for you. I look at the implied volatility and the historical volatility of every single option contract I recommend. I always make sure that the option contract is cheap enough to give us a margin of safety so that we have really everything working in our favor. So that's the explanation for why these call options are probably going lower as Tesla's going higher. But again, I can make it a lot more simple. If you join my service, Home Run Profits, we're basically buying call options at one price and selling them at a higher price. And I take care of all the other factors like time decay and volatility and everything like that.
So the takeaway here is that if you're getting into options, or if you are experienced with options or inexperienced with options, but you want to get into it, one of the key factors you have to look at is that implied volatility versus historical volatility. We've talked about that before. I know I talked about it. I had a question on our marijuana market update about cannabis options, and if there's a market that is somewhat volatile, cannabis is it. And brought those lessons out. So I encourage you to check those out. Plus, Adam has talked about options on several occasions here on YouTube. Would definitely encourage you to do that. If you are interested in Home Run Profits, which I will tell you is a fantastic service. I don't say that because I'm sitting with Adam. I actually believe that the returns are outstanding, and he does do the work for you. Makes it very, very simple. So whether you're a novice or a seasoned veteran, this is a very simple service to get involved in to make the potential for a large gains on trades. Then we'll try to leave a link somewhere here on YouTube or down in the description so you can get more information on that. But other than that, Adam, I appreciate
one
it.
thing. I would be remiss to say one more thing. I've quoted the price of this call option on Tesla as about $18,000. But that is atypical. I just want to let viewers know that most call options do not cost that much. In fact, in my service, Home Run Profits, I hardly ever recommend a call option that is more than $1,000. The average price of the call options I recommend are in the $200 to $400 range. Sometimes it's $500 or $600. Sometimes it's $100. But really, the average is about $300 per contract. And that's really one of the advantages of buying options and trading options, is that you can make a leveraged bet on a stock or ETF that you like with much, much less money than you could if you just bought the shares outright. And your risk is absolutely limited. There's no way, even though there's leverage involved, I say that it's what's called non-recourse leverage. So the broker cannot come after you and asking for more money. And again, you can get into these contracts for a few $100s a piece. It's not 18,000 typical. So I just wanted to clarify that.
No, I saw it and I saw $18,000. I was like, gee, that is a massive options contract. That is a massive price and is very, very uncommon. So, but again, if you do have a question for Adam or myself or for Charles Sizemore, then I encourage you to comment below here on YouTube or email it to us at feedback@moneyandmarkets.com. If we do use your question and we answer your question on one of our videos, we're going to send you some Money and Markets gear. Randy, thank you for your question again. Appreciate that. Look for our team to reach out to you and get some more information from you so that we can get get you some money markets gear in the mail. Adam, again, appreciate it. Love sitting down talking with you each and every week. We're going to keep doing it and look forward to doing it even more. Check out all of our stuff on YouTube. We've got the Marijuana Market Update, Ask Adam Anything here, as well as Investing with Charles, which is a series we do with Charles Sizemore, Greens and Fortunes co-editor, and the Bull and the Bear podcast, which we do every week as well. Adam, until next time, definitely appreciate it and look forward to doing it again.
Sounds great. Thank you, Matt.